When you purchase a stock, you're buying a tiny slice of ownership in a company, whether that's Microsoft, Apple, Amazon, or Tesla. As the business grows and performs well, the value of your shares usually climbs too. But if the company runs into trouble, your investment can shrink just as quickly. Stocks have historically produced some of the strongest long-term returns of any investment type, which is why they sit at the core of most portfolios. They're easy to trade through brokerage accounts and can also pay you dividends, which are portions of the company's profits sent directly to shareholders. That said, stock prices can swing sharply based on headlines, market sentiment, or economic changes. You're also exposed to company-specific problems like bad leadership decisions or declining demand. On top of that, emotions play a huge role. Fear and greed often push investors to chase highs and panic sell lows, damaging long-term results. Bonds are often viewed as the steady, responsible players in the investing world. When you buy a bond, you're essentially lending money to a government, city, or corporation. In return, they promise to pay you interest at regular intervals and give back your original investment, called the principal, on a specific maturity date. Bonds are generally more stable than stocks, which makes them attractive to risk-averse investors. One of their biggest strengths is predictability. They provide consistent income and are commonly used to smooth out the ups and downs of a diversified portfolio. Government bonds from financially strong countries are considered especially safe. The downside? Returns are usually lower than stocks, and bond prices can drop when interest rates rise. Riskier bonds, like high-yield or junk bonds, also come with a greater chance that the issuer won't be able to repay them. In other words, bonds vary widely in risk, and understanding what you're buying matters. A mutual fund works like a pre-mixed investment bundle, combining dozens or even hundreds of assets, such as stocks and bonds, into one package. Instead of selecting investments on your own, you pool money with other investors, while a professional manager makes the decisions for you. The big advantage here is diversification. If one holding struggles, others may help offset the loss. That makes mutual funds appealing for beginners who want broad exposure without deep research. However, convenience comes at a cost. Management fees can quietly chip away at returns, and you don't get a say in which specific investments the fund holds. In many cases, actively managed mutual funds fail to outperform the overall market once fees are factored in. Index funds and ETFs are go-to choices for hands-off long-term investors. An index fund is a type of mutual fund designed to track a market benchmark like the S&P 500, instead of trying to beat it. The result is fewer trades, lower expenses, and reliable market-level performance over time. ETFs, short for exchange-traded funds, often follow the same indexes but trade on stock exchanges like individual stocks. You can buy or sell them throughout the day, giving you more flexibility. The appeal of both comes down to simplicity, low costs, and instant diversification. One purchase can give you exposure to hundreds of companies at once. The downside is that if the overall market falls, your investment falls with it. And while many ETFs are broad, some focus narrowly on specific industries or trends, which can increase risk. Real estate investing usually means owning physical property. That could be a house, apartment complex, retail space, or even a vacation rental. The goal is to earn money in two ways: rental income and appreciation as property values rise over time. In strong markets, real estate can deliver solid returns from both angles. There are also tax advantages, such as deductions for mortgage interest, depreciation, and operating costs. Unlike stocks, real estate is tangible. You can improve it, rent it out, and physically control it. But it comes with challenges. Properties require large upfront capital, ongoing maintenance, and dealing with tenants. Repairs can be costly, and selling a property isn't always quick or easy. If you want exposure to real estate without becoming a landlord, that's where REITs, real estate investment trusts, come in. REITs are companies that own or finance income-producing real estate, ranging from apartments and malls to offices, warehouses, hospitals, and data centers. Buying shares in a REIT means you're investing in a professionally managed portfolio of properties. REITs are easy to access through brokerage accounts and often pay generous dividends because they're required to distribute most of their taxable income to investors. They also offer built-in diversification across multiple properties. The trade-off is sensitivity to interest rates. When rates rise, REIT values can fall as their dividends become less appealing. Cryptocurrencies like Bitcoin, Ethereum, and Solana are digital assets powered by blockchain technology, a decentralized system that records transactions across a network of computers. Unlike traditional money, they aren't controlled by governments or central banks. Crypto has drawn massive attention due to its explosive upside potential. Early adopters saw enormous gains, and many believe blockchain could transform entire industries. The market is always open, and anyone with an internet connection can participate. But the risks are just as extreme. Crypto prices can surge or crash within minutes. Regulation remains uncertain, with countries taking vastly different approaches that could reshape the market overnight. And if you lose access to your digital wallet or private keys, there's no customer support to bail you out. Your funds could be gone permanently. Commodities are raw materials traded worldwide, such as gold, silver, oil, wheat, natural gas, and coffee. These resources power the global economy, and their prices move based on supply and demand, politics, and natural events. Investors often use commodities as a hedge against inflation or economic instability. When paper currency loses purchasing power, assets like gold often hold their value or rise. Commodities also add diversification since they don't always move in the same direction as stocks or bonds. However, they're not beginner-friendly. Prices can swing violently due to wars, weather events, or policy changes. Successfully investing in commodities requires understanding global markets and complex tools like futures contracts. Direct access often involves specialized platforms or funds designed to track these assets. Options and derivatives are advanced tools that let investors speculate on or protect against future price movements of assets like stocks, commodities, currencies, or indexes. With options, you're not buying the asset itself, you're buying the right but not the obligation to buy or sell it at a set price before a certain date. Call options are used when you expect prices to rise, while put options are for betting on declines. Because options use leverage, small investments can lead to large gains. They're popular for short-term strategies in hedging against losses, but the risk is significant. Options are complex, time-sensitive, and can expire worthless. A wrong move or bad timing can wipe out your investment, or worse. Certificates of deposit, or CDs, are among the safest investment choices available. They're ideal for people who prioritize security and guaranteed returns. You deposit a fixed amount of money with a bank or credit union for a set term, usually from a few months to several years. In exchange, you earn a fixed interest rate. When the term ends, you receive your original deposit plus interest. CDs are FDIC insured, so your money is protected even if the bank fails. They work well for short-term goals or for storing cash you don't want to risk. The downside is modest returns. CDs typically earn less than riskier investments, and pulling your money out early triggers penalties that can erase your gains. Private equity and venture capital involve investing in companies that aren't publicly traded. These are high-risk, high-reward opportunities. Private equity usually targets established businesses that need funding to expand, restructure, or turn around. The goal is to increase the company's value and eventually sell it for a profit through a merger, sale, or public offering. Venture capital focuses on early-stage startups with explosive growth potential, often in tech or biotech. These companies may not be profitable yet, but investors are betting on future dominance. The upside can be enormous, but many startups fail, and capital is often locked up for years. Because of the risk and long timelines, these investments are typically limited to accredited investors with substantial income or net worth. Art and collectibles fall into the category of alternative investments, assets outside traditional markets. This includes fine art, rare sneakers, luxury watches, vintage comics, trading cards, and other culturally significant items. Their value is driven by scarcity, demand, and emotional appeal rather than financial fundamentals. While collectibles can be rewarding for knowledgeable enthusiasts, they're difficult investments. Selling can take time, pricing is subjective, and spotting true value requires deep expertise. Without that insight, it's easy to confuse hype with long-term worth. Now that you know how these investments work, the next step is deciding which ones deserve a place in your portfolio. And if you want a real-world example, my ETF portfolio with documented performance is linked below.